FXBros.
What's up, everybody? If you're on here now, I just jumped on a little early just to get everything situated, but we're gonna get started soon. Let all the people that's gonna hop on, so we can get on this ride.
What's up, bro?
Uh,
Chilling. Now I just want to make sure. So we won't be showing our screen. It'll pretty much be like a
not your screen per se. It'll be all what I got shared up right here.
right. Okay.
I got different tabs I got open that I'm probably we'll utilize and stuff.
Cool. I want to get my screen.
Got a few
All right.
questions we got from people that we go answer on the live.
Oh, you have some already?
Yeah, I got a few, plus some others that I know people gonna want to know about.
Yeah. No, most deaf, man. Let me get my my espresso, and yeah, I'll be right back.
All right, bet.
All right.
Yeah.
How's my sound? Is it good?
Perfect.
Sound good. You took any trades today?
I did, but I didn't hold as long as I wanted to. That was the situation with today.
Yeah, I didn't take any.
Yeah, I was taking buys
Okay.
from that wick
Not
down, basically what the daily did, and yeah, I got in a little early on some entries, but like I said, it didn't hold. I didn't hold as long as I wanted to on them, so but
right.
still profitable.
Good.
Were you looking at anything today?
My bad. I was trying to see if I could switch my mic, see if it comes, how it sounds. Oh no, it is that. Yeah, I looked at the charts. I didn't really see anything. I mean, I saw that it was moving, but I wasn't. I was looking for an entry to get in, and I didn't get a signal. So I was like, you know what?
Yeah.
I already had a good trade, but that was Sunday. But
Sunday.
I
Yeah.
wasn't. Yeah, it was Sunday. Yeah, so I got that, and then yeah, I haven't traded since.
Yeah, it's been bullish since Friday, basically.
Mm-hmm.
Kind of at a
Yeah.
resistance level right now, but
All
it
right.
like it could break out.
Facts. Oh, let me get. I'll be right back.
All right. Mm, mm, Didn't you set up that thing that live from your page? Or you set it up from my account when you set that event? Oh, okay.
But that was just the event, and I guess you gotta put the link inside of it.
Yeah, I was gonna send you the link if you could do it.
Okay. I don't think I can access your account.
Oh, okay. Okay. I don't know why I thought you set it up and I shared it from your account.
Oh no, it's
Okay.
yours.
Okay. I got you. Yeah, we'll get started in a little bit, y'all. We'll wait for Jay. Wait for whoever gonna hop in and hop in.
Ugh. All right.
Yep. We're gonna start at like 6:05.
All right, that's what's up.
We got like 30,000 people supposed to be in there, so we're gonna let everybody join. You heard me?
Boy, get ready. Yeah, give it some time. Nigga, can you imagine in the future?
Man, hey.
I'm gonna say no because I'm gonna be
If
ghosted.
if I know, right? If it comes, it comes. But hopefully, everybody go take heed of all this, all this documentation we've been putting on YouTube for all these years, because the market's not really gonna change from what we've been seeing now. They still gonna
Give you opportunities.
still give you opportunities. So go higher or lower.
Yep.
So
That's a fact.
nothing really gonna change.
So I think, well, no, I ain't gonna say I'm gonna just mute my video, but I think I should. That way, when you switching back and forth.
Yeah, I mean, you can. Unless if you want to just, interject, or when I ask you shit or whatever. It's all on you, brother.
For sure.
And you good? You ain't having no house party or nothing right now?
Nope. Hold on, let me.
Yeah, it's a little bit better. It's a little bit more better. we just go jump into it. This is basically uh, a live we wanted to create, just that also for one to have on our YouTube for other people to review and play back in the future. But overall, we just been getting a lot of questions from a lot of people that's more so interested, beginners, and just want to get like the basics of what's all going down, what's the whole inner workings of Forex, or what is Forex. And we just gonna keep it real basic, we're not going through no strong strategies or teaching about any type of indicators or anything like that. Just the basics, just to answer some of the basic questions. So we just like, let's do a little live. You heard me?
Coming from us,
from the horse's mouth.
Yes.
So basically, we created an ebook that kind of goes over this, so we'll be following that kind of in a situation, going along with what we're talking about. But that is also getting formatted right now and getting a cover created for us. So by the end of the week, we'll have that and be able to send that out to be on the website. But anyway, just to get started, overall, I know the initial question, people understand, if you're interested, people kind of know about Forex because it is going around. It's a popular term right now, especially with the interested people that have some kind of investment interest, whether it's in Forex or whatever. But nonetheless, Forex is just basically a term that's short for foreign exchange. And it's just a market of trading currencies, and it's different currencies from different countries. So it's typically traded in pairs versus the stock market that's traded in like shares, single shares. So how you trade Forex, you trade one country's currency against another country's. And there's tons of pairs out there. It's probably about like 6 or 8 core important pairs we'll talk about. But that's basically what it is. And the most powerful, or the most I guess highly regarded currency against its opposer would overall determine what you see on the charts, as far as those candlesticks we look at when we see on the charts. That'll determine the increase and the decrease of that movement in price. And just to go a little deeper, what moves that price is one core thing I could say. I don't know if you agree, if you probably agree, Jay, is like the interest rates of that currency overall. That's what determines who's powerful, whether the USD out of the euro or the German pound from the Japanese yen.
That release explains a lot.
Right. Yes. And that's where you can you'll find what pair or what currency out of the two is more powerful, so you could determine to make a trade. But nonetheless, that's in a nutshell how and why we trade two pairs against each other, and that's how you place trades in the Forex market versus any other situation like the stock market or futures. Is more of a single share situation. Just some little simple history about Forex. It kind of started way back in time with the history of like the Japanese rice traders. That's how we even got the formation of the candlestick, which we'll talk about. That pretty much started around like the later year, the 1600s, early 1700s. And from that information and the growth of other forms of currency besides rice and tulips and whatever else people traded back in the day, converted into a form of, real currency, whether it was backed by gold or it's actual gold or paper or whatever the case may be. And that's what we have real currency today. But it kind of derived from that, if you will, the act of trading rice. Just some basic numbers just to debunk a lot of things that people may not know. Is the Forex market is the biggest market out there. It's bigger than the stock market. I could say it's bigger than a lot of markets combined, for sure. Like the stock market, crypto, probably futures, probably all that combined. The foreign exchange market is the largest, and right now, based on information, it's moving about $7 trillion a day throughout that market every day. That's on average. Sometimes it's more, sometimes it's less, but on average, it's moving about 7 trillion, and it's been growing. I know when we started, the number was like 4 or 5 trillion.
4 or 5, yeah.
Yeah. So it's been growing just with the interjection of cash from all countries. It's gonna always grow because that's what it's trading, currency, real currency. Our what they call that, it's actual fake currency. It's not real.
Oh, fiat,
yeah. But another thing that's different in the Forex market than other markets that you can trade at, it's open 24 hours a day, only 5 days a week, really 5.5, but 5 days a week. So that 1.5, if you will, day that it's closed, or days that it's closed, is that Saturday, full day of Saturday, and pretty much the first half of Sunday. The market opens Sunday at 5 p.m. and it goes all the way until Friday, that following Friday at 5 p.m. So in a sense, it's a 24-hour market for that time frame from 5 to 5. Sunday p.m., Friday p.m., 5 o'clock. 24 hours. We and when I say we, like you and I, we are considered like retail traders amongst the international banks and hedge funds and institutional traders and all these big banks that move large amounts of money around. We are considered retail traders. So we have a large pool of money that we pour into the market as far as trading volume, that volatility. But for the most part, the people that really move the market is the banks, institutional traders, and hedge funds. So when you see the market moving and you see, just like in any market, stock market, that's typically a hefty size trade that has to take place. And when I mean hefty, I mean in no less than like probably 100 billion, like real talk, as far as for this market, that would considerably, move the market. And no one trader in the Forex game is trading $100 billion. That's just not, it's not being done. If anybody, that's hedge funds, that's banks, they're the type of people that's moving that kind of money. So saying that to say, just on some deeper knowledge, when you learn more tactical techniques and different strategies, you want to typically follow the banks and how they move and how they trade. Whenever they put in large amounts of money, you can tell by the way the candlestick moves, the size of the body of the candlestick, and this a picture of a candlestick right there. We'll talk about that later. But that's how you can tell when volume, they move, they add volume, they add volatility. So that's how you can tell when volume comes in. We look at what the big banks do, and that's how we get into the market. And it's only a certain time of day, which is another good thing, that typically happens. Would you agree, Jay? It's probably multiple times, but for the most part.
No, I agree. And, to narrow it down, because people just think of like, what is actually a foreign exchange market? What is a foreign exchange? That's exactly like prime example, as if, you would travel from the States, from
Mhm.
Florida or something like that, Orlando, Florida, and then you take a trip to London, England,
Yeah.
and you can't spend your US dollars there. You're
Nope.
going to have to take your money or your card if it's, internationally transactional,
Mhm.
and convert your US dollars, which in the Forex market, that's USD,
Right.
to the European dollar, which is EU.
Yep.
Yes,
EUR, but yeah, the
EUR,
euro. Yeah,
EUR.
yeah. Mhm.
And those are two main ones because people
Mhm.
from the States, our like closest, I mean, if you really look at it, our father, as far as like other states, is the UK and the London and all those
The
countries.
Europeans, yeah, yeah.
European. So that's why I just put that out there. But that would be the same if you would go to any other established, I guess you would.
Like
Um,
Australia,
yes.
China,
What
uh,
else?
this was
Canada,
Switzerland, yep, Canada,
yeah,
uh,
Britain,
Japan, yep,
Great
Britain,
Britain,
yeah,
yeah, Japan, and there's a list,
yeah,
So just to explain what the exact foreign exchange or forex, that's pretty much like to put it in terms of like everyday living. That's why you have 7 trillion converted every day.
yeah,
It's not like you got a new group of people bringing another 7 trillion. Just like, no, the transaction of doing business and trade throughout these countries or pairs.
Even if you're not trading, if you, like you said, if you just taking that trip and you converting your money, you a part of that 7 trillion.
Exactly, that's what I mean. Yeah, yeah.
Yeah,
So every day that's what's happening. And but yeah, you continue, Six, to
yeah,
go into how people traded and so forth. And
yeah. But like I said in the book right here, they say they create large moves in the market that we as retail traders can turn into a profitable opportunity. So that's why I said, you want to see what they are doing, what the big banks are doing. And the only way you can tell, because you can't call them up and ask them what they're doing, you got to look at the candlesticks and they'll tell you.
yep, and you
Like I
can be a
said
part.
before, right, right. The Forex market consists of trading pairs. Trading pairs are two currencies that are tied together. These pairs move as one currency is gaining or losing strength over the other currency. Just like I said before, that's how they move it. The dollar, say for instance, and we're gonna get deeper into that, a little deeper into that, but basically this is it right here. How we break it down. The Forex pairs consist of two currencies. Both currencies can impact the pair. For instance, when major news events, and this is typically what moves and what motivates the market for these banks to get into the market and make, if you will, rash decisions and, adding a lot of money just to make a lot of money and move the market in their favor. When the news comes out and it happens on the USD, all the pairs that are tied with the USD will be impacted. I didn't say what kind of news. They just said when news come out. I don't care if it's bad or good. That those pairs that's tied to the USD will be impacted. When it's positive news, like interest rates dropping, or jobs growing, or home sales growing, or non-farm payroll is at a average that the economy can grow, all these different news events that come out, it will gain strength if it's positive. That will cause any USD slash whatever other pair, because like I said, it's two pairs together, that will move up. And any pair against the USD will move down. So say for instance, the pair that we trade the Australian dollar against the USD. So what it's saying is when you look at your trading pair, you want to look at the first currency against those two. So we trade it's Australian dollar USD, right? Or yeah, Aussie dollar, yeah. We trade that pair. So the Australian dollar is listed at the beginning. So if you look right here, this is the pair we trade right here. Australian dollar, AUD, USD. So anything that positively happens to the USD, to the Australian economy, when they have good news, this market we see, the candlesticks, should, not saying it will always, it's not like you could trade this, because it's deeper aspects. There's way more deep aspects in this. But in a nutshell, if the Australian economy has received good news, this should increase this pair, and we should see candlesticks going up. And conversely, if we see negative news for the USD dollar, this should go up. And the opposite happens for USD, which is our country, the country we pay attention to mostly. When we have good news, this trading pair should go down. Why? Because when you look at this price right here, this is telling you that for every Australian dollar, this is how many USD dollars we'll give you. So when people come from Australia and they bring $1 to USD, we give them 66 cents. We don't give them $1. So when the USD dollar, when the US economy is stronger, which it typically is, than the Australian economy, and when they have good positive news, that's going to make the US economy more powerful than the Australian economy. So that would make their exchange much cheaper. So now if it drops down to 65 cents, so when you come back to USD, instead of getting that 66 cents for $1, now we give you 65 cents. Why? Because our economy just got stronger. And typically your economy got weaker. So that's basically, like, in a kind of nutshell, how you break down the pairs and how they move accordingly to the strength. Like I said, the news is one of the biggest catapults on when the market typically will have a kind of large injection of volume from the institutional traders, from the banks. Like, the banks know all this. They know when the news is coming out, and they probably know what's going to happen with the news before it come out. That's just something we got to deal with after the fact. We got to catch the aftermath. But it's cool because you can make a lot of money in the aftermath. So that's all Forex is. You're not controlling the market or moving the market. You're just participating in the move. If we going across the street, then I want to go across the street too. We going back across the street, then I want to go back across the street too. Like, we just following the market. Simple as that. This is a chart of the sessions, because Forex market is traded in different sessions, meaning that countries from that area, or that certain economy, will have a lot of their news releases or a lot of their volatility happen around that time, typically. And how it looks is, and this is GMT time. So basically, if I can break it down in our time zone, which is central right now, the London session, which is right here, this 7 would be a 3 o'clock roughly. So London session starts roughly about 3 o'clock, 2 o'clock in the morning, and it goes all the way until about 12 noon. The New York session starts about like 6, 7 o'clock, and it goes all the way to 5 o'clock p.m. our time. Then we have the Sydney, which is the Australian session. That goes all the way until about midnight, 1 o'clock in the morning. And also about 2 hours after Sydney, we had the Tokyo, the Asian session. And that starts about like 8, 9, 10 o'clock, and it goes all the way until about like 3, 4, 5 a.m. roughly. Well, pretty much around like 3 a.m. So if you trading London pairs, where the first currency in those pairs is a London type of currency or a European currency, whether it's the euro, I want to say want to say like the Swiss franc is in there, the German pound is in there, and there's potentially some other currencies I'm not sure, but those are the major ones.
Like
Then we have
NZD.
NZD, yeah, New Zealand dollar. I think that was be in there too. If not, that would be in the Sydney
Oh
session.
no, in Sydney, yes, you
Yeah,
are right.
that would probably be in the Sydney session.
Yes.
But nonetheless, we got New York, which is only one pair USD. We have Sydney, which is Australia, New Zealand, and maybe one other if we're not. But those are the two main ones. And Tokyo, we have the won, the yen, and I think that's it, right?
Yes.
Yeah. So if you look at these blocks, basically what it's saying is this is where the power is at for London. This is where the power is at for New York, and so forth and so on. What you can also see in this chart is that we have overlapping over some of these times. Like a lot of these times are overlapping. Like one is starting in the midst of the other and all that type of stuff. So right around this time zone, which would be around 6, 7 a.m. to like 10 a.m., you have this London, well, really to like 11 a.m. You have this London and New York crossover scenario happening. That time frame is one of, if not the best times to catch a consistent trade opportunity every day. So if you want to wake up in the morning or however you want to, get your opportunity to trade, this would be one of the best times. It's not the only time, it's one of the best. The second best would be if you are a late night person and you can catch midnight into 3 a.m. because you get the Tokyo and you get the London and a little piece of the Sydney all kind of crossing over. So that's power right there. The third powerful most time is the evening, which is typically everybody get off work. So this is an easy session of trade for people that get off work, work that first shift. You can catch that 8 o'clock to midnight time over to Sydney, and lucky for us, one of the pair that we trade, which is Australian dollar, gets a lot of its movement, a lot of its news releases around this time. So we get a lot of volatility out the Australian dollar, which can lead us into the London volatility and then the New York volatility for the dollar pair that we trade against the Australian dollar, because it's two pairs. So you get a piece of that, and then you can carry that on into the New York session. So that's a plus for when you have two currencies that's actually listed on this chart, if you will. They do it, like I said, it's really probably like 30 or 50 different currencies you can match up and pair up, but it's really only a core of about 8 of them. So let's talk about candlesticks, and I'm just gonna bring up this chart right quick so y'all can see. So we're looking right here. This is the chart of the Australian dollar. These red and green lines are candlesticks, and they basically indicate highs and lows of.
Excuse me, bro.
Yes, sir.
Can you clear the indicator? Because I know that may confuse people, like for the first time just seeing it.
Oh, okay. You're right. Bet. Right. And basically these candlesticks indicate time from the bottom, which is the open, to the top, which is the close on this bullish candle. Bullish means up, means buy, means increase. And a way to remember that is when a bull fight, they swing their horns up. They go down and swing it up, pop up method. So that's a bullish move. It's going up, bullish. And opposite is the bearish candle, which we have the open right here, and then we have the close right here. It's the bearish market. The reason they call it bearish, when bears attack and you fall your ass down, they pounce on their front two hands on your chest to crush it. They're not gonna kill you and eat you. They eat berries and shit, but that's how bears, fight. They pounce down. So it's a bearish market when it's going down. So that's how you remember that, bearish and bullish. But that's just a candlestick. And like I said, these represent time. And what time frame do we have it on? Because there's different time frames you can set these candlesticks to represent. Right here is a D for day. It's a daily time frame. Each candlestick is representing a day. No, the daily doesn't start like a day you would consider like 12 midnight. The daily actually starts at about what, 4 p.m., 5 p.m.?
Yes, 4 or 5.
Around 4 or 5 p.m., depending on what time zone you're in, but roughly around that time. So that's when the new daily candle, like when these candles start to form, that's when they start. Any other time interval will start on whatever time is you have it set to, basically. But as far as the daily, they start at about 4 or 5 p.m. Like I said, it depends on if you're in the central time zone, eastern time zone, and yada, yada. So let's go back here to just break down what a candle does. Basically, you will have a open, a close, a high, and a low. And the way that's determined is by the body of the candle and the wicks. These little high points and low points that you see out here that's sticking out, just like there was on the charts that I showed you. Those are called wicks. Basically, what it's saying is, if this was a bullish candle, which I'm thinking it is because it has the open up here, the open is where it started. So let's say this is an hourly candle. This represents 1 hour of time. So at 6 p.m., price would have started right here. What would have happened is price would have went down a little bit and then went back up to this open. When price goes to a certain low point and the candle is still alive, meaning it hasn't closed and hasn't ran through its whole full hour, then it will leave an indication called a wick, letting everybody know this is the lowest it has gone so far during the duration of this life cycle of this candle, which is an hour. So say, for instance, from 6 o'clock to about 6:10, 6:15, this candle went down and then went back up and indicated that based off the size of this wick, that's how low it went. Like sometimes they have long wicks or short, even shorter than this. Or sometimes no wicks. It'll open right here and just shoot straight up. But that's what that wick is. So from 6:15, the candle moved up, 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 all the way to this high point of this wick, indicating this is the highest this candle has gone throughout the whole duration of the hour, from 6 to whenever it's about to close at 6:59. Then from that high point, it'll start to come down. It'll retest a little bit, rest, get exhausted, and it'll eventually close at 6:59 and 59 seconds. And that's how you read a candle. That's how it forms. It'll have an open and a close, and it'll indicate how low it went in a wick, and it'll indicate how high it went in a wick. And that's basically how you read candles. When you want to say how high did this candle go, you look at the wick and see how low did it go. You look at the wick. Where did it open? If it's a bullish candle, you look at the lowest part of the body, this whole rectangle. If it was a bearish candle, that means it would have started up here and closed down here. It would have been a red candle. This is a bullish because it opened down here, closed up there, so it went up. Bullish. So that's basically, in a nutshell, how you read a candlestick. Any other thing you want to add on that? Because I was just about to go into just the charts in general and how we kind of look at the movement of price and all that stuff in the charts. Like,
Yeah,
what exactly are we looking at when we be sending all these screenshots on Instagram and Facebook? They be liking it, they leave hearts, but I know they don't know what the hell is that.
Right. It's like if you want to scroll back to the candle illustration, yeah. So like if you go to the second one in the middle, it's just good to notice in this illustration how uh, a candle how it can move before it closes. Like the
Right.
one on the left, that's an end. That's a solid candle and it closes. Which
What
with
I just
these
explained.
two exactly. With these next two illustrations explains the movement that
Yes.
that candle could have done. So
Yes.
it's showing right now, and the one in the middle where it opens,
Right here.
stating yes, and then it's
Okay.
showing that it went down initially.
Just like I explained.
So initially in the first 15 minutes
Right.
and 10-15 minutes within this hour, it's actually forming a bullish or a red, I mean a bearish, excuse me, a bearish or a red candle.
True. Yeah. So, and yeah, you're right. In the first 15 minutes, this from the open to where it went down to this wick or down to this little endpoint, there, that candle would be red. So it would
Yes.
be looking red. You're right.
Yeah.
It doesn't
So
change
you can
color
be
till it goes back up.
correct. So you'll be looking at that and it's like, oh, it is going down, which it is. But right after that, it would shoot up. And now it's forming a green or bullish candle because we're going up.
Facts.
And then it goes down a little bit and then it closes right there. Boom. So that's how the candle closed. So let's go to the third candle and see how many times this one got you faked out. So with this one, it opens
Right here.
immediately within 1 to 15 minutes. It shoots up. So you're thinking like, oh man, this is happening in this hour. So
Right.
this is looking good, you
Yeah,
know.
shot up. So it went all the way up to this high. It's a
Yes. Now,
green candle
granted,
at this point.
right. Now, granted, if you look at the middle illustration, it showed that it shot up, went down a little bit, and closed. Like that's what it did for the entire hour.
Yeah.
It already shot up past that area where it closed.
Right.
Already, you know what I'm saying?
In the
And
first,
it can't
what, probably 15 minutes, 20 minutes.
15 minutes, 15 minutes. So yeah, so you're thinking like if you would see, let's say this is a new candle, you would think like, oh, it's going up higher because
Let me get
before,
in.
yeah, let me get in right there. And then up, nope, next 15 minutes, it goes all the way back down. So you
Past
like
where it opened.
past where it opened up at. So you really like, oh man, so it's gonna drop down, man. Like it passed it up. You mess around and get in again, and then it shoots back up to where it closes and made the exact same candle.
Right here.
So it just shows explains like and that happens in the hourly time frame. Those candles form the same way in the 5 minute time frame. So it's just like what happens in that 5 minute, and a lot of things can happen. Um, just looking
And
at
I'm
the
gonna say
certain
this scenario, this whole kind of faking you out scenario to get this same bullish candle in the outcome. This typically will happen around this time when we have that London and New York crossover, right when things getting heated up before New York really opens up and start to take over, and the New York Stock Exchange come into play. That's deeper news, but that's when this will happen typically. Not all the
yes,
time, but typically. Then
yes,
after
yes,
that happens and we confirm that we going higher, then you'll start to see these scenarios.
that's a fact.
A little pop down straight up, and then the next one, a little pop down straight up. You know,
Yes.
you'll tend to see that type of scenario. Like this will happen in the crossover of those times.
Right, which is why you should always wait for the candles to close. But we'll get into that. I mean, we preach that all the time. Everybody preaches that.
Right,
But
right, right.
wait for the candle to close. Yeah,
Yeah.
we can.
So let's we had a question on Instagram, I mean on Facebook, to talk about pips. Like what are pips? So before we get into breaking down just the charts in general and just one of the most basic things you can look at when you want to understand charts, which is support and resistance, let's have a little brief talk about just pips right quick, and how that works. And I'm probably going to do a little search right quick of an illustration because I'm not sure if I have that.
And shout out to that person
Yeah, that
that asked the
was
question.
we had contemporary current. Contemporary
Oh
current
man,
asked that question.
I
So shout
appreciate
out to
that.
contemporary current. We about to look through it right
Yes,
now. Like I said,
yes.
I'm probably gonna pull up another illustration. So just you know, talk about pips right quick before I pull this up. Just what is a pip? Let's see.
Yeah, well, six kind of look up, some illustrations. As far as like pips, PIP, I like break it down into my own unique way of, description, definition. And I like to break it down like an acronym and say it is points in percentage or points in price or percentage in price. You
Well,
know,
you very yeah, you damn it close as hell. I mean, not to cut you off, but what it actually stands for is price interest point or percentage endpoint or price interest point.
okay,
So it's kind of whatever you want it to be. Okay,
exactly.
you can call it whatever you want it to be, but it's basically how we look at the movement in price
Right, which you
and
can
different.
measure that. Yeah, like once we pull up the screen, I mean the chart, you can kind of measure a candle just to show them like the numbers as far as like how you can look at the numbers of the price open and close to determine, okay, that was a 10 pip, that was a 30 pip candle or something like that.
Right.
Yeah,
Nah, that's big facts. I found this little cool illustration.
nice.
Um, Shout out to Baby Pips. After y'all watch this video, definitely want to sign up to Baby Pips. That's a good little extra, more deeper information for all the beginners out there. Like I said, we ultimately started Forex. I mean, FX Bros. Not 1,000% gear for just beginners. We always know the beginner aspect of Forex, but for the main, for its main purpose, it's more of a novice, intermediate, expert type trader that we discuss our knowledge and what we see in the markets. But we doing this for everybody that really want to get it and get this knowledge and learn from somebody that really been doing this, not nobody that's, that just say they are. There's a lot of people that are. But nonetheless, what is a pip? A pip is points, it's pipettes, which is like the smallest number, the smallest increment that a price moves, and that's basically how we make our money off the pipettes. That little bitty increment in movement. The unit of measurement to express the change in value between two currencies is called a pip. So that's basically all that it could have been called a flip, a dip, a rip, a tip, but they called it a pip. Okay. Basically, in the Euro USD, this trading pair, if it moves from 1.1050 to 1.1051, that is 0.0001 USD rise in value. That's one pip. So when you see the market move from that 50 to that 51, however much you are trading on or however much risk you have on that trade will determine how much is your pip value, how much how much in equity will you increase based on that pip rising. You know, it could be $1, it could be 50 cents, it could be $5, it could be $1,000. You know, all depending on your equity and how much, you know, risk and leverage you have on that trade will determine how much you can get paid per pip based on this movement in price. Like I said, every pair is different. This is the Euro USD, so basically stating that when we take a euro to USD, we give them $1.10. So they make a little bit more money if you look at it on that level. And conversely, if we want a euro dollar and we go to USD, I mean, if we go to any European country and we want to get a full dollar, we can't give them $1. We got to give them $1.10 just to get a full European dollar, if that makes sense. Just to, you know, add a little explanation on that. A pip is usually the last decimal place of a price quote. Same for Australian dollar, and I'll quickly just jump to the charts just so you can see physically. Right here, as you can see, this is the price movement of the Australian dollar. This 29 that you see at the end is moving because the market is live right now, but that 9 would be a pip. It just moved up. Actually, that is a pipette. Our pips would be this too.
Yeah, correct.
So this 5 that's moving, that will be moving way more frequently throughout price movements throughout the day. But this second number, the number 2 right here, this, which is it's like 4 decimal places away, that's our pip. So from 92 dropping down to 82, that would be 10 pips. That's how we read our pips. It's like I said, slightly different. I can pull up the Euro USD right now just so you can see. Bam, Euro USD is moving. See that 6 just changed? 3 to a 5, 35, went to 36. It's kind of hovering right now. This is like the dead time of the market, so it's not going to be moving a lot. But nonetheless, their pips would be this 13. So the 13 moving to 23, that would be 10 pips for this market. So it's not the actual last number. That would be the pipette, that last number that moves so frequently throughout the market. That's the pipette. So as you can see, basically back to the explanation it was talking about the Euro USD, like how it explains right here. A pip is usually the last decimal place of the price quote. Most pairs go out 4 decimal places, but there are some exceptions like the Japanese yen. They only go out 2 decimal places. And we'll look at that too, just so y'all can see that. So basically, they already have it up. So this is the Japanese yen. So this is the 2 decimal places that they're talking about. And these are the 4 that they're talking about that you see in like pretty much every other currency pair besides a Japanese traded pair. So you would see the price extended out 4 decimal places, and this last area would be the pip. Now, they really messed up on this illustration because this really would be the pip. I don't really like how they put this right here. This really would be the pip. This is a pipette, like how they explain it down here. Pipette. That's the pipette. That's what moves more frequently. So for this 54 to change to 55, this has to go from 1 to 9 into the next rung of numbers. So that's the pipette. What you want to look at is the last 3, if you will. That's how you find your pip move. So for us to make 10 pips on this GPP USD, we would want this market to go up from 1.3054 to 1.3064. That's how we get 10 pips in that market. Euro USD. Oh, I see what they did. This is the pip because they took off that last. They took off the pip. Okay, I see what they did. So this is the pip. So Euro USD for this to go up 10 pips would be from 1.1051 to 1.1061. That would be 10 pips increase. So that's a little breakdown on pip. Do you agree? Anything you want to add on that?
No, well said, bro. Well said.
So when we looking at all these charts and we showing y'all screenshots and everything, I know it look a little crazy. It look a little weird. It's like, what am I looking at? I'm unsure what I'm looking at. This is foreign to me. One of the easiest ways I can tell people to learn about structure of how price moves, because price moves in structure, and it shows it on the charts. And we call it bearish structure or bullish structure. And the way you determine bearish structure is lower lows and lower highs. So from this high point, this point right here would be a lower low. This swing point right here would be a lower high. Why? Because this high is lower than the previous high or this previous high. So these are all lower highs. These are all lower lows. That's bearish structure. That's when the market is going down, meaning it's taking out levels and dropping below it. Taking out levels, dropping below it. It's taking out levels, dropping below it. Taking out levels, dropping below it. That's bearish. Opposite is the bullish structure, which is higher highs and higher lows. So we have two lows right here, but as you can see, bullish structure starts to add right here. So we have a low point, a high point, a higher low, a higher high, and so forth. It didn't really go for much, but that's basically what a bullish structure looks like. It's a lower high, a higher high, a lower high, a higher high. That's bullish structure. Some of the key points that we want to look at is where certain swing points, meaning like this is a swing point where the market went from bullish to bearish, or where the market went from, bullish to bearish, and from here, bearish to bullish, bearish to bullish, bullish to bearish. That's swing points. So what we want to find in those swing points is common areas where they met. They met at the same point, and it doesn't have to be the same point exactly to the T. So if you get a price of, like for Australian dollar, we get a 0.6658, that other price point that matches that or returns back to that, it doesn't have to exactly be at 0.6658. It could be in a zone. It could be like a zone of like 20 pips. So you can take that price of 66.58 and go 10 pips lower, 10 pips higher. Anything in that area, and I would do this on a higher time frame, like 4-hour daily, but anything in that area of that zone, and I know this is a little, extra knowledge for y'all, but that's what we would look for markets to either return to and reverse from, bounce from, or potentially or eventually break through. So this is a example right here. The first chart is showing you support, what support looks like. Support is just a point of support, meaning the market struggled to break through a level and it kept wicking down but never closed any of the bodies, like how this long bearish candle, this long black bearish candle closed below here. We didn't get none of that action below this point. So that's support. It's holding it up. It's allowing it not to break through. And it's even stronger support when you have this price coming down and touching it. So if this price tried to come down, this candle tried to come down and break through this area, couldn't. So that's even stronger. When you have more than two, really more than three touches, that's a real strong area of support or resistance. And for it to break through and not continue to just bounce like this, it's going to have to take a very strong, volatile, heavy volume type of candle. Nothing weak, nothing like these little small, weak ass candles. You need a strong body candle to close through a strong support. Typically in the market, what happens when you have a strong support and it finally gets broken through, what we'll see is price likes to come back to that area for resistance. So it's resisting the market to break back above that. It's not all the time it does this, but typically in a perfect scenario, which it happens more, more enough. It happens enough to where you can turn it into a profitable situation. Put it like that. So that's the good thing about these markets. That they remember certain price areas like an equilibrium, like it's like like that rubber band effect. You stretch it out, it comes right back to its original size for the most part. So it's just extending out and it's coming back to its original size. So that's basically how you can look at certain resistance levels, like that midpoint, that median. We have extensions out, whether they're high or lower. And typically price likes to return back to those median areas, those areas of where support matched up with resistance. And as you can see it perfectly right here on this price chart. There's another one right here where we have, again, multiple touches of a market trying to break through, but it couldn't. So now that you have multiple touches in the same area where it's circled, now you have confirmed support. You can draw your line however you want to draw it. You can draw it at the wicks, which it looked like that's where they put it at, or you could draw it right at the bodies. They don't have to be perfect. You just need to know this is typically where the market is either going to bounce from or it's going to break through. Like I said before, what will take a breakthrough of a strong support or resistance is a large body candle. You will typically see this a lot. If you look at your charts, or when you do start to look at your charts, you'll see when you see a strong support or resistance, it's always a big bodied, a strong bearish or bullish candle that is needed to break through that. Otherwise, we'll be having a lot of little small, weak body candles that are just showing a swing point to reverse from. Just support. I can't break through that. It's too strong. Support. I can't break through that. But then this big body candle, like, yeah, I got that. And not only after it breaks through that, price comes up and taps that and turns it into resistance. Now we having a struggle of breaking above it. And that's where a lot of people can people just trade this setup alone. Like I said, this is one of the easiest ways to look at the market, and you can just trade that alone. It's a lot more strategies out there once you get deeper into Forex, but for the most part, this is one of the most important things you want to look at. And when you're looking at support and resistance, you want to look at it from a higher time frame. We're gonna go to the actual charts and kind of break that down too. But yeah. So like I said, once we get done with this ebook, we're going to pass this out to everybody. We'll have it available on the website for download. Just basically giving you guys the basics of just developing a strategy, following a strategy, our strategy that we use, trading plans. Got the $1 million plan. This is how to properly set up and follow a trading plan. We talk about the future of just trading your account, the growth and continuation of staying consistent, and then ultimately the future of Forex. Just what can we expect in the future? And yeah, we're going to have this out for everybody so y'all can look through it. Like I said, we got a lot of history about Forex, basic introduction of how we got started and all that. So that'll be out soon, probably by the end of this week. You heard me. So now that you know a little bit about candlesticks and all that, this is what we see. This is the charts. This is the Australian dollar. So right off bat, when you're looking at a chart like this, so I'm going to zoom out a little bit so we can get a little bit more price action. When you're looking at the daily, you want to just mark up some key things just to let you know as a trader what's some important areas. Just to throw out some little basics, I like to mark. Like I said, this is the daily, so we're looking at the all days of the year so far. That this little time spread that I have that's showing basically from September 2022 to today is July 11th. So one thing you can do, draw a little vertical line and kind of show you the beginning of the year. That's one thing. Since we're on a daily time frame. So bam. That's Monday, January 2nd, the beginning of the year. So we want to look at price. Let's look at what it did at the beginning of the year. Or this year. So like we explained support and resistance, let's look at areas where the market touched at least twice. And we go mark that down on this chart. And by the way, the charts that I'm drawing on, that we have this amazing ability to write and mark up on, is TradingView. So you can go to tradingview.com and get you a free account. And once you start messing around with it, you can tap into the paid version that give you a whole lot more tools and stuff to use, but you can get by with the free account. It's not needed, in my opinion. But let's start from the beginning of the year. And anything you want to add, bro? Like I said, I'm just breaking down just some support and resistance on the daily.
Yeah, no, you're good. You're good, man.
All right, bet. So basically, one thing I see that I don't know if you see, but this is all beginner. So I'm going to show you what I see, and what you should be looking at is this area right here. We had the market. So like I said, this is the beginning of the year. So instantly, since the market opened, we went straight up. You know, we had this little drop down, but overall, we went straight up. Bullishness, right? I see this area where it struggled. It tried to go down. And not only did it try to go down, it tried with 3 wicks right here. So you see that area. This is not a real strong swing point. Not like this is. This is more defined of a swing point. But I still like to notice where markets struggle. Like market struggle right here. Try to go down lower with this candle, with this wick. Let me zoom in a little bit better. So the market tried to go down right here, but struggled, shot right back up. Tried again right here, shot right back up. But the market also returned to this area. That's really my major second touch. A lot of these touches are cool, but this is the real second touch. We want to see the price leave, create a swing point, come back down and touch. So I want to mark that up. That's my first sign of resistance. Now I can expect price to either respect that area or break through it. And like I said, we need pretty, strong bodies or solid body candles to break through strong resistance. So we see this price touch it, bam. We have our line we can follow. We put the line right here. Next time price comes, you want to kind of go in the mind frame of expecting it to support it and hold it. That's how you want to expect, because the reason why I say that, because you're going to get good risk to reward entries. When you got support created right here and you expect the market to respect that support, you could catch buys that's going to catch you, in a sweet entry, and you can have your stops below this support line. And when I mean stops, I mean stop loss, meaning that's a line that you will place underneath. If you buy in the market and you're expecting to go up, you go put your stop loss underneath the market, and that's going to determine how much money you willing to lose before you want the market to get you out. And I'm done. Take the trade off, cancel it, delete it. I was wrong. Get me out the market. Let me get ready for the next opportunity. That's what a stop loss is used for. And the opposite of that is a take profit. When you place in a buy down here, you want to put your take profit at a pip value or the next area where you expect the market a price to hit, and you will put a line called a take profit line. So when the market goes up to that area and touches that line, then it's going to take you out, and it's going to calculate your profit, throw it in your bank, and you're going to be a happy camper. But that's all that emotional shit. Don't get too happy, because the opposite is right around the corner, because it's all inevitable. Winning and losing is inevitable. It's going to happen, so get used to it. So back to the support, we see the market came right back down to this line, and what did it do? Did it respect it? Yes, it tried to break through with this wick, but it closed right there and bounced right back up. This market tried to tap right back down into it. Like I said, price doesn't have to be an exact number, but this is like considered a zone, because look at the respect from here. This is from December. Same area we looking at support was resistance in December, just like I talked about in that breakdown in the ebook. It's the same situation. Like I said, the price loves to respect strong support and resistance. So with that being said, now that we see price rejecting this again as support, we see it's returning back bullish. But what it's not doing, it's not going in a extreme fashion of price increase. We're not taking out no highs no more. We actually slowed down and we turned around halfway through this move. So that's my first sign of like, you know what, we may be about to break this, because now we starting to create a lot of price action real close to this strong support. We might be about to break. That's what I'm gonna start thinking. I don't know. It could turn right back around, like especially with this candle shooting all the way down here, this long candle, and then closing right back up. Basically, what this candle did was it opened here, went all the way down. This is the daily, so this candle represents a whole day of time. So all these hours throughout the day, and it came right back up to where it opened at. So it didn't really do much. The bears was trying to show that it wanted to break through, but the bulls was like, nah, we're not ready yet. This is not. No, everything that comes beneath this area, we buying up. So it's just a fight between those two, the bulls and the bears, until you get a heavy indication of that the bulls are done. They done with fighting, and they'll show that in the candlesticks. You'll see a lot smaller candles compared to the bearish candles. You see a lot of bigger, stronger, defined bodied bearish candles that'll combat these weaker bullish candles. It was only strong when it was going up, when it was making high highs. That's when you had the biggest, strongest bullish candles. And you see these bears starting to come in. Then ultimately, the bear broke it. Like I said, it might not be the biggest candle that broke it, but it was a strong body candle. You see that wick? Can't even hardly see it. So the market closed at the extreme low that it gave out for that whole day. That's powerful. Almost did it the very next day. That's powerful. This is where indecision and weakness is, when you got candles creating wicks down here and wicks up here. Like, it don't know what it want to do. It's indecision. You want to see power. Power is like a full body, whether it was big like this or if it's not as massive as some of these, but it's still power because it closed at the low or very near the lowest point of that day. So nonetheless, we finally get our sign that the market is breaking through. And that's typically where you will want to drop down to a lower time frame. Like I said, this is more hefty news. I'm just trying to give y'all the basics, but typically when we see this, we want to drop down to a smaller time frame to catch our entries. And as you can see, the next day kind of retested back up into this zone. Didn't tap this line exactly. Like I said, I don't have to be exact, but it tapped into this equilibrium level, this zone of pricing, and furthermore continue selling off. Not only that, if you have the patience to wait, which is this? February 21st, Tuesday. If you have the patience to wait and we look, the market came smack right dab back to that area. What is this area now? Resistance. It was support. It was holding it up. It was resistance here, turn to support, holding it, holding it, holding it, holding it. Finally, we broke through. Traded lower, did what it had to do, and where did we come to when we had our very first interjection of buys? And remember, Jay, we was in all these buys from June 1st to June 15th. We was going crazy in the market, caught all them buys. Where did it reverse at? That same daily support and resistance. That's why I said market loves to come back. It's like a man, I don't know how to explain it, bro, but it's just like that median, like that homeostasis type state of where it just needs to be complete. Like it extends further out for bullishness and then extends down for bearishness, but it always comes back down to where it was mostly respected, which is that equilibrium, that mid ground of price action. And there's multiple levels. This is not just this level. So another area we could look at is these. See how these candles? So we can take this and I can duplicate it. Now I can place this right here and look at the respect. See how the candle, it took very large candles to try to even break through this and make a decision on what it didn't do that around here because it already pushed through a strong level. Big candle to break through this area. We had support right here off this wick, if you can see it. So wick right here, we bounced off, and then a big candle to break through. Retested right here off this wick, sold off. Came back, respected, sold off. Came back, respected, sold off. Came back, respected, sold off. Finally broke through with a lot of weakness in my eyes. But it was only doing this. It only showed this. I mean, even though it was a body that broke it was a weak body, but it was only doing this to give its last push to push to this old resistance from earlier in the year. So it had to give a one last push to reach to this other level of resistance. And thus we came back respecting it with these wicks, couldn't break through. And then we get another strong body breaking through and bam, continuation for sales. We ain't talk about nothing else, no indicators, no other candlestick patterns. That alone, if you just understand just how to draw a support line, like you said, you need at least two. I like three better, but 2 to 3 touches of that area, and that's how you can properly draw support and resistance lines. Let's see if we have any down here. This could be one. I like that. It's not the best one, but it is. So this level down here, the lowest point we had early in the year in March was respected here. Market broke back up, then it came back down. How did it break through? Broke through with a big body candle. Retested right here. Struggled a little bit, but the very next candle broke through with a body and then retested right there to the T. Bam. And shot higher from there. Chances are we gonna see some market hesitation when we get back to this area, or we're gonna get a strong body candle to break through to attack this area down here. And that's basically how you trade. And this is on a daily time frame. The same scenario can happen on other incremental time frames. So we have the 4 hour. This is important. So basically, these candlesticks are representing 4 hours. So if you see me move across my charts right here, say 1700 hours, go back 1300, 9 in the morning, 5 in the morning, 1 in the morning, 2100 hours, 17. I got it in military time, but you get the gist. It's breaking down in 4 hour increments. So every candle is representing 4 hours. And as you can see, as far as time is concerned, this current candle, that's a 4 hour candle, is about to close in 44 minutes. The time is counting down right now. Same thing as we go back to the daily. You can see the time right here. We have 20 hours until this daily candle's close. Why? Because it opened around that 4 o'clock time frame on this is New York time zone. So that was, I think it was 1700 hours. I think that's 5. And right now it's 8 o'clock there. So there you go. 3 hours and 15 minutes. The market's been open so far when this daily candle opened. So basically, so far the daily candle open right here. We are bullish, but before we went bullish, the market dropped down lower and created this wick. So basically, this wick right here is telling us this is the lowest point so far within the first 3 hours and 15 minutes of this daily candle that we've seen price do. It went this low, and currently we at this high. But we have 20 hours and 43 minutes until we close this candle. So it can go all the way up here. It can turn around and go all the way back down here. Who knows? We don't really look too deep into the daily. We just look for structure, just like how I wrote down all these swing points. We use that for the daily, and we want to get in a trade and look at it. We drop down to smaller time frames. Like I said, we have the 4 hour we can look at. You see how the 4 hour respected all these levels, gave you a nice little setup, nice little entry opportunities. You already had this structure set up, and you get another one here. Break back above and a retest bounce. You could have caught that buy. Drop down to an hour. And as you can see, every candle represents 1 hour of time. $41 left for this 1 hour candle to close. And we go all the way down to 30 minute, 15 minute, 5 minute. You can see the 1 minute. So I'll show you what it looks like when it's actually moving. So we just had a pop up. Oh, see that? You could have been rich. Now the flat. But yeah, man. That's what typically happens in the morning, every morning. That's why it's good to catch that morning volatility and the late night volatility, which we're about to start creeping into at 8 o'clock. But this is early signs. This is what the market does before the volume gets in. It's like that pre-volume to show you where we trying to go or where we manipulating your ass to think we trying to go. And then you give it some time, 8, 9, 10 o'clock into 11, and it'll give you some opportunities. It does every day. And if it doesn't, it's cool. You wait for the next day. We don't force nothing. Absolutely nothing. Anything you want to add on the charts, bro? Just to briefly, like I said, I just want to talk about some simple stuff, nothing too in depth.
Yeah, no, you got it, man. I mean, just going through all the time frames on them, how, we kind of just set it up, basic price action, support and resistance trends. And yeah, man, from there, you can kind of just scale into your own plan.
And we got that all in the book.
Yes.
If y'all need help, tap in with us on Telegram. We got a chat group on Telegram. We talk daily on there about the markets and what the pair that we trade, which is the only pair we trade, the Australian dollar. We talk about it in depth, what entries we taking, where we getting in, where we getting out. So if you just need that, that support or whatever, holler at us. We will add you. So now that we got the understanding down of basically what we looking at and how we read candlesticks and wicks and highs and lows and all this, how do you even get started? Like, where do you go to get started? Well, we recommend that you need a broker first. And the broker we kind of recommend, and we're not getting paid to recommend this, is if you go to Google and you type in Oanda, that is the broker that is regulated in the US for US clients. There's hundreds of brokers out there that are not regulated, so that's at your own risk. But I would highly recommend that you stick with a regulated broker so you ain't got to worry about nothing. Everybody taxes is paid, everybody Gucci. Run it up, get your money. So this is Oanda. Basically, the account types that you want to get. Let me see. You have to go to create an account right here. And I'm not sure how far they're gonna let us go without actually creating a real account. But I do know, unless if things change since, because we've been having our accounts since like I don't know, like 4 years. But basically, here you go. Oanda offers a wide range of tradable currency pairs. When you open a live account, a demo account will automatically be created for you. So that's why I recommend getting started with this, because you automatically get a demo account that you can start to do test trades from, and you'll be good to go. So during the application, because when you open this account with Oanda, is very similar to a bank account. When you open a bank account with Chase or Bank of America, so you need your social security number, passport, driver's license, or other photo ID and proof of residence. I don't think the passport is a heavy requirement. I'm not 100% sure if you actually definitely need that, or you can get away with your driver's license. I think the license is good. And I know you're gonna need your debit card when you want to fund your account. What's the minimum they take right now? You know, is it like anything or $10 or something?
Yeah, I don't know the minimum. I know the maximum is like, you know, for I don't know, the average person's like a couple grand or something like that, I think.
Okay.
But it should be no minimum.
Okay.
But let's just say $10. Like,
Yeah. I don't think it's no minimum either, but yeah, $10. Regardless what it is, I like to throw a minimum out there, 100, just so you can test the waters. But yeah, whatever you want to start with, just to test the waters, you can do that with Oanda. It's not like you need 12,000, 1,000, $5,000 to start it. Once you build up your strategy and your ability to read the markets properly, then you can throw some big money in there and really get active and start to make that big bread, that daily bread. But yeah, that's pretty much where we're gonna stop at as far as this Oanda situation, because they want me to like put in all my details and everything. But you can go and go check on YouTube. There's a lot of videos about Oanda and how you can open an account with them. But like I said, it's very easy. It's just like opening up a bank account. There's nothing to it. And when you do get an account, you will have your account that looks like this. And I'm gonna put that up on the charts right quick. Let me see. Let me get my Oanda back on here. You heard me?
so good. Hope everybody doing good, man. Appreciate y'all tapping in with us on this beautiful Tuesday evening.
Mm-hmm. Let's see. Damn it. let me log back in on that. You can't share your screen, huh? Because I was basically just about to go to show them about what's the process of opening a trade and closing a trade in Orlando.
Let me check right quick.
You got so many windows up. Yes, live is being recorded. So anybody that need to watch this at a later date, you can. There we go. So Jay about to just go down and explain just the basics of opening a trade. You know, just open a little tester trade, a little, and close it. You know, give them the whole breakdown.
Yeah, man. So, like I said, this is my charts. I like. I've been on my Miami Vice as of late. I've been running it up with these colors, so I'm gonna stick with it. How about that? So yeah, as far as like, this is what the charts usually look like on Orlando. You can change the colors of these. Like if I click on it and change, rising color, which is my bullish color, I can change that to any color. Usually it's red and green. I switch mines up. My falling colors are purple, and my rising colors are this cool cyan. So it's a little different, easy on the eyes, I guess. I don't know, but I like rocking with that one.
I like
All right, cool. But this here at the bottom is one of the indicators. My only indicator that I like to use is the RSI. I know a lot of people don't get down with the RSI. I kind of like it. It just looks good, and it's a little confirmation. But what I'm gonna do, I'm gonna remove it just so we can just be naked for the time being. I got the 30-minute on right now just because I like what it's doing, and depending on how this closes, I might enter a little tester trade live with you guys. But let's see. It's the 5 minutes. Yeah. So how to enter a trade? You know what I'm saying? On here, what we're going to do is
basically they're gonna be looking at the same thing eventually when they open with Orlando.
Right.
For the most part.
So I guess to just enter right in, you can just click on the screen, right click or whatever, and you can go to.
The market is running, boy.
Yeah, I missed the button. But but what you would do is, because I was going to put a freaking order right there, but oh my god, goodbye. Yeah, you can put in I think a market buy. When you hit market buy, and this is for buys, you will enter in your units, and it'll show.
That screen is not being shared for some reason because it's a pop-up.
Yes, because it's a pop-up. But what happens is you will click on the screen, you can see this pop-up right here, and you can hit, market buy, or you can do market sell. Simple as that. Entry buy.
Entry.
Yeah, I'm about to say entry buy and entry sales. Those are orders to where they will
enter at that exact price.
Yes. Yeah. So you can like set it right here and say, okay, while this is retesting, I'm gonna go ahead and do an entry buy at whatever whatever units that I want to enter it in. And I'm gonna go ahead and put one in right quick. Submit, and then okay. So now, what do you know? That order got entered because it's moving. I put it right here above, right where that candle closed on. This is the 30-minute that I'm looking at, and I just entered on that. So now I'm actually in this trade. Now, once I'm in it, I can click. If you can see right here, there's an arrow. So I can click on that, and I can modify my take profit, which just I just put it at 10 pips. I like securing at least 10 to 15. This is just a little tester. I'm doing this live, guys. And I can also set my stop loss.
Right.
Let's say the top stop loss, I do a 1-to-1. I do 10 pips.
And right now, that trade is in profit.
Yes, it is. So right now it's in profit.
It's above the market.
And it's about to, oh my gosh, what is it doing?
Did news come out?
Yeah, let's check the news.
God.
Please check the news.
Okay, let me see. Because my FX book is tripping. The site is down or something.
Wowzers.
Well, we got Australian news tonight.
Governor, okay.
Governor Lowe speaking at 11. But that's still playing that.
So what I did, I had to scale back. Like I'm on the 1 hour, I'm looking at the 4 hours, like where can this go? And it can easily hike up to about right here. I really think it can go up to 67.40, which is like a nice 30, 40 pip move. So yeah, so we're just gonna let that ride out.
That was a great scenario for
ridiculous.
I mean, yeah, it's crazy how the market just popped up like that. Like that's wild. What time frame is that?
This is the 15 minute.
Okay.
15 minutes. See, I like these. If this one closed above here, and I'm in space. I gotta back up. I gotta go to the 1 hour. Oh, what do you know? The 1 hour is in space to the left. All right, let's go to the 4 hour. And then now I have some type of structure. I can look to the left and see. And this is advanced. If you go on our lives, like this is what we do. So I look to the left. This, I can see it hitting here and doing something. Once it breaks through here, what I'm gonna do, while I'm on live, I'm gonna move my stop loss and move it right above my entry. So now I am risk free. This can go down, slam down, and I am going to be out in profit.
Yep.
So now this trade is immediately turned into a risk-free trade. It actually broke above this first TP right here. So once it starts doing that and closes, like 8 o'clock if it closes, I'm gonna move my stop loss into an even higher.
What do you mean by like risk-free? It's basically saying that even though the market is in profit right now, it's higher than his entry. He moved his stop loss above his entry. Like he said, so no matter what, if the price goes back down, he's not going to lose any money because it's above his entry. It'll basically just break even or be an even wash. No money lost. And then you'll have a scenario to potentially probably get back in.
Enter right there. Initially had my stop all the way down here because it shot up. I moved it all the way up here.
Gotcha.
So yeah, and that's on the 15 minute. Just to zoom in, it looks a little bit better. But
yeah, I wish we could have showed the little pop-up box where you could type in the parameters so they could see how you enter a trade. But nonetheless, that's basically what it looks like. It'll have an arrow pointing in a direction of where you enter that, and it'll, like I said, you can set your parameters on where you want the stop loss to be, which is the red line, and where you want your take profit to be, which would be that green line up there. Right there. So that's his take profit, that green line. So he expecting the market to rise all the way up there, hit that, and then he would be in profit, and that money would be in his account. Simple as that.
That's it.
That's it.
This is actually my second trade. I'm gonna go ahead and count this because it was on the live. It was my second trade of the week. This was an impulse, just because we was on the live, so I'm just doing this. But yeah, initially.
Now, one thing I want you to point out too, even though this is a tester, we were just basically showing people how to enter a trade, which we ain't really get to do a great job because it didn't pop up right. But why did you put in a buy and not a sell? Even though we just testing the trades out. You could have put in any kind of trade. Why did you put a buy in? Why did you buy the market? What was making you think the market was going up?
Now that we backing out, this is the daily chart.
All right.
So like 2 or 3 days ago, which is the 7th. I'm sorry, that's 4 days ago. So the 7th. We got a bullish engulfing on the daily. And
what's a bullish engulfing? Zoom in on it.
I do not like zooming in on my stuff. Hold on, let me. As you can see, I am a new trader. I don't even know how to zoom in. But
there you go.
So what you got is 2 bearish candles or 2 candles of the same, and then a third candle that engulfs the middle candle, if you will. So
overtakes that whole candle.
Overtakes the whole candle. Not both of them, just one. So you got one right here, bearish, and then you got this bullish that covered this bearish candle, which is engulfing. So now that kind of switches my bias of trading from sales to buys. As you can see, we've been selling off pretty good. Didn't get an engulfing, but we got a couple of just continuations right here and stuff like that. So cool. So when I noticed that, I go to looking on the 4 hour.
Drop down.
Yeah. There we go, drop down, or I like to say zoom in to the 4 hour. So let's see what we got. Okay, so the 4 hour right here and right here, we had 2 bullish engulfings. So on the daily, it lets me know I was bullish. It lets me know I was looking for a bullish move,
Right.
Then I get a confluence on the 4 hour. Happened right here. I got some of that. And then this is what I'm working off right now. I got this. So that was my 4 hour bullish engulfing. So now it's like, okay, I know for sure that I'm bullish. Now let's zoom in. Now I'm going to the 1 hour. As you can see, I do not have a bullish engulfing, even though it's just been rising to the occasion. I haven't got a bullish engulfing. But what I did was...
Well, you didn't get a color change, the FXBros color change engulf, but you did get that candle is engulfing. But
yes, that's true. That is true. I didn't get the one that I wanted, that I like. So that's why this is an impulse. So when this started moving up towards this area, like this little area right here has no wick. That's clean traffic, what I call it, like this candle right here. Mm-hmm. You can see once it broke above this area right here, I figured like, okay, it would have to close for it to continue going. As you can see, we still in this 1 hour candle. So this sucker is zooming. This was
20 minutes left too.
This is perfect because if you rewind this live, Six was talking about how it takes a big candle for it to break through a lot of touches. You see, got one right here, got one right here, and if I scale back, I'm sure you'll have another one. Anyway, so what I did was like, okay, I'll enter into that, but I have to get a close. Now I zoomed in on the 30-minute.
And what did you get?
My close right
The
here.
close
So
right there.
that's when I was like, oh, I
And it
missed the boat.
closed slightly above that high point.
Yeah, no, but I actually had it right here. Like my line was right here because I just wanted it above these wicks. On the 1 hour, it looks different, but on the 30, I was like, oh, okay, if I get a close above here, I'll enter that because that's clean traffic. But it shot up and passed through that. So that's when I was like, okay, this is an impulse. So that's why I entered in live.
Come on, man. Making money on the live during the webinar, bro. Like this don't happen often, but that was a sweet entry.
Yeah, I was not expecting this much of a move, but hey, it happens a lot.
As I said, it happens a lot more often than than anybody know. You just got to be there to you just gotta participate. As simple as that. You can carve out some time out of your day, whether if it's in the morning before work or in the evening after you get out of work, you can find several opportunities. And like I said, you don't have to look at the smaller time frames. You can look at the 1 hour, the 4 hour, and just look at your charts. Pull it out on your laptop every 4 hours. Just look at it and see where it's at. See if you want to catch an entry. You know,
that's what I highly recommend that for all my people. 9 times out of 10, if you trying to figure this out, you working. You have a job, or what I'm saying, you have another ways of making money. So you won't be devoting all your time. You shouldn't be devoting all your time into trying to get something out of the markets. So by looking at the 4 hour, you can just really take a look at it for like 10, 15 minutes, see what it's doing, and then you can make a decision on it,
right.
And that's what you call swing trading, but there's a lot of different. What I just did just now was a scalp for the most part. I did a quick scalp, and it has every right to come back down and take me out in profit.
All right, tell them this. Where would you normally enter off this hour? Even though you just entered because we were just doing an explanation on how to enter a trade and and all that. Where would you show them? Where would you typically enter off of 1 hour?
I will wait till this close.
Is that at the 1 hour?
Yeah, this is the 1 hour.
Oh, okay.
So I will wait till
what time frame you had before that? The 30-minute?
Yeah, the 30.
Oh, because the 30-minute showed that bearishing. Well, was it? Well, it showed a bullish one back there.
Right here.
No, not right there. Before that.
Oh, right here.
Yeah.
So yeah, it's coming from.
What time was that? That low point.
That was 8.
8 in the morning.
Yeah, 7:30.
Prime example, like I said, that morning crossover, London, New York crossover. That's the prime example where you get a lot of volatility.
Yeah, so yeah, but now 7:44, about to be 7:45. You can even look at the 15 minutes, see what's going on. So these are quick little scalps that you can probably get into something good. I don't recommend scalping. I just did this for the live.
Right.
But to go back to what you asked, when I see something like this, I already caught the move that I wanted, from way back here or something like that.
Right.
So if I'm not still in this trade, then it's all good. Like I ain't gonna get back in. So what I'm looking for now is, because we broke out, I'm looking for some sales coming back down to about right here in this area, and then I'm looking for another bullish engulfing, something like this or whatever. I'm just looking for another bullish engulfing, and then I'll get back in.
Gotcha. Yeah. So basically what he's saying, he expecting the market to go up and come back down the way he entered at, and then potentially catch another entry to go bullish, to go back up, to buy the market.
Yes.
Yeah, man, that's perfect. So let me see, make sure We good on the YouTube chat. I'm gonna run through some just some little questions, and we just gonna go through and just answer them right quick.
Okay. I mean, you got the screen, right? Or do I have to click stop?
You can leave it on just so they can see it.
Okay.
I'll just pull up the questions right quick. It's some we already talked about, so I'll skim through them. But basically, what is Forex and how does it work? Forex, what is Forex trading and how does it work? Like basically, what we already talked about. Forex trading is just the trading between two currencies or two countries' currencies, and defining which has the most power between one another. And the only way we can determine that is by looking at the candlesticks and seeing how they form. Are they doing engulfings like Jay was pointing out? Are they is it a swing point? Is it turning? Is it going down and turning back up? And what size of the candles? Are they big bodies? Are they breaking through support areas? Are they coming back to a resistance? And that's basically how we determine if we're gonna get into a trade or not. And that's the nutshell of how it works. Uh, how much money do I need to start trading Forex? Answer that. What's your answer on that, Jay?
I would say anything that you're comfortable with losing. Let me put it that way.
Great answer.
Yeah. So yeah, on to the next.
What are the major currency pairs and which one should I trade?
Oh yeah, that's U6.
We kind of went over some of the majors, but it's the euro, the USD dollar, the German pound, the Japanese yen, the Swiss franc, the the CAD, which is the Canadian dollar, and I want to say that's pretty much all in Australian dollar. So no matter which pair you pair them up with, those are the major currencies. So if you kind of stick with those, whether it's the USD Jappy or the Euro USD or the GBP USD, and when we say Euro USD, that means it's the euro against the USD dollar. The GBP against the USD is the German pound against the US dollar. The USD against the JPY is the US dollar against the Japanese yen, JPY. The Swiss franc is CHF. That's how they do the Swiss franc, CHF. So those are the major pairs. Like I said, we trade the Australian dollar. We recommend that one. It's a very beginners worthy pair. It moves very smooth, and it's something we've been following for over 4 years. So if you got any questions about it, we got you, hands down. Next question. How can I analyze the forex market and predict price movements? Well, the best way we showed you was looking at those points of where the market touched multiple times, that support and that resistance level, which we was talking about.
Yeah, that's true. I mean, you can analyze it by price action. You can also analyze it. I would say, you can do it technically, but you can also do it, just by looking at the news and the reports.
True.
Like you got,
True.
you know what I'm saying?
And that's more fundamental. When you're looking at news, that's more of a fundamental approach. You're looking at what the economy is going to do.
That's it. Yes. So that was my point exactly. So it's like you can analyze it by looking at the charts, candlesticks. That's it. And you can also analyze it by, like what Six said, just the fundamental side of it. So you can understand that the economy is prime for a recession. But you look at the stock market, and even though it's like a handful of companies that's really making it look good, but it's just stuff like that. So yeah.
Let me see. I think I got it shared on the screen now.
Yep, you got it.
Okay. So, what is the best trading strategy for beginners? Do you have an answer for that? The best trading strategy? How would you answer that? I would say the best trading strategy for beginners is, if I had to give it a real answer, it would probably be looking at support and resistance and trading off of that. You want to at least learn that, because that move, that notion of looking at 2 points or 3 points that touch to create support or resistance, and then something breaking through that happens on all time frames. So that would be one of the easiest ones. But the real answer is so many out there. Once you get into researching and learning different trading strategies, you'll find one that matches your personality. That's the real.
I was about to say, there is no strategy for a beginner because you have no experience.
Facts.
Like, so yeah, just like what Six said, yeah, get in it, look at price action, the typical, support and resistance areas and zones, and yeah, just get it in, man. Figure out your moves and your plays, what works best for you.
And like how we said, when it goes off of your personality, if you a person that can't be patient, you don't have a lot of patience, with Forex will teach you patience. I don't care who you are. If you ain't got no patience, start trading Forex. You'll learn patience, especially if you really want to get good at it.
Either that or you'll lose a lot of money.
Yeah, that too. But if you don't have long-term patience, like you gotta have patience in all trade. I don't care if you're a scalper or you're a swing trader, which is a swing trader is a person that's looking for larger moves. Like you waiting for the market on like the daily or the 4-hour time frame to come back to a point for you to buy or sell from. That's a swing trader. You waiting like days or weeks for a trade to set up. A scalper or what I find as a day trader is a person that's entering and exit trades within that day, or sometimes within an hour. And you still need discipline and patience for that. But there are strategies that will allow you to get into the market, somewhat, I can say every session, maybe even every hour. Looking at a minor time frame like the 1 minute. Like I said, we don't recommend that, but it's all based on your personality. If you're not the type of person that can sit and just wait for big, large trades to set up, then you'll find trading probably maybe too boring, or it's just more of a longer process than you expected. And you can try scalping scenarios to see if that's going to work better for you. But for what we've realized after 4 years plus of trading, like that longer approach of waiting for a bigger move, even if you're waiting on a 1 hour, you still will have times of and periods of waiting. It might not be a full day or weeks, but it's still going to be some time to wait for that trade to set up.
Yep.
How do I open a Forex trading account? We kind of briefly went over that. Oanda is who we recommend opening a brokerage with. The only reason is because they are one of the only, I think it's maybe one or two others that's regulated in the U.S. for Forex trading.
Yeah, that's a ton of them, especially nowadays. They popping up left and right. But yeah, pretty much the same type of sign up, um, type of thing that you have to go through is very similar.
Right. but it's just the regulation is something we recommend because, like I
Yep.
said, you can lose more than your money potentially
Facts.
trading with those unregulated brokers. The next one, what is leverage in Forex and how does it affect my trades? Leverage is is that the term they use? They call in Orlando, the leverage 50 to 1, right? That's your leverage.
That's it.
Okay, so your leverage is basically what your broker will allow you to actually place trades in the real market. So, for instance, the leverage that we have placed in the US that's regulated is 50 to 1. So every dollar you put up, the Forex broker you trade with will place $50 in the market based on that trade, if you will. If you have it set to 50 to 1, that's in a nutshell, that's how it breaks down. So you'll see when you trade in like $100 trade or whatever, you'll see the trade value or the actual trade amount to be like $1,000 or $1,300 because that's that leverage added. So you able to move with the market and assume a certain amount of money that your $50, $100, or $1,000 by itself wouldn't allow you to capture. So if you really want to see how strong your dollar is in the Forex market, set your leverage to like 1 to 2 or 1 to 1. And you'll really see how much money it takes to really gain some traction in these markets. So 50 to 1 is our regulated number. It used to be higher, but I think they dropped it down for obvious reasons because it was just a unnecessary greed type of parameter that people had to play with. So they had to drop that down. But the unregulated brokers, just to talk about them, they have leverage of as high, I've seen some as 1,000 to 1. Typically, they're gonna be about 100 to 1, 200 to 1, 300 to 1. But I've seen some crazy brokers out there that's 1,000 to 1. So yeah, you could. It's crazy to say, but you could literally turn $10 into $1,000 probably in a few days. Now I say that to be truthful, but you can also lose that $10 fast. Now you won't lose it and be negative $1,000, have to owe somebody some money, but you could lose that money to where once you have no more money to put up for leverage because you are negative on a trade, they'll have a thing called margin call. Basically, they calling your ass like, hey, you got some more money to put on this trade because all your money you had on this trade is gone. We got that now. So you either could ride this trade out and pray and hope that it goes back in profit. But right now, we're going to need some more money. And typically, I think they give you like a day or two, depending on where price is on that margin call before they close out your trade for you. They'll close it out for you. And it's just a safety mechanism, just so you won't go negative $500 and then they be like, yeah, you owe me some money. That's basically all that is. But that's why we use stop losses, so we ain't got to worry about shit like that. Next question. How can I manage risk and set stop loss orders? Perfect. Next question. You can manage risk by realizing where you are placing the trade. When you get into a trade and you are looking at a support, so let me go back to the charts right quick just to hop on. Let me see. Let me share my screen. Share. Bam. We are now shared. So when you see a market returning to, this is the 4 hour. Let me go back to the daily. Well, sure, I could do this. So we had the support drawn right here on the daily time frame. And just to show proof, we go to the daily. And that's this right here, Friday the 10th of March, the 10th, 6th, 8th, 13th, or whatever, all up in there, that little weekly area. of March. So we go to the 4 hour. This is how you manage risk. This is that same time, the 8th, the 9th, the 10th of March. When market returns to that, you expecting it to reject that. Especially when it see a sign, when you see a sign of it's trying to swing early and it didn't touch it, but it's so close, expect it to have a nice push down, tap that and reject from it. Just expect that. Like you always want to expect market to respect support and resistance. You don't want to look at it is it to break, but when it does break, be prepared for the retest to catch that opposite side. So respect the support, we want to wait for market to try to tap that, maybe potentially break through, but close back up. We don't want to see this where bodies open on this side and close down here or break through. We could tap through like these wicks right here. These wicks are tapping through the line, but it's not breaking. The bodies are not breaking through. That's what we want to see. So we see that again here, a wick. Your risk, you want to manage risk by looking to place trades at support or resistance. So when it's at a support, meaning it's holding the bottom, you want to be looking to buy because you want to buy the bottom. You want to sell high, sell low, buy high. Or sell high, buy low. Yeah, that's what I meant to say. So you want to buy low. I got mixed up a little bit. Buy low, sell high. You want to buy the discount, you want to sell the premium. So basically, when you get to a support, a confirmed support, you want to look to place a trade right there. Why? Because your risk to reward will be greater, and you want a great risk to reward. That was the question. How do you manage risk? You want this shit to be great, not poor. So to have a great, so you will place your stops, like say, probably like 5, 10 pips below the low. This is the 4 hour, so maybe 10 for sure. So this low right here is 65, is right here, this black number to the right, 65.72. So I want to go 10 pips below. I want to go 65.62. So I want to move this to 65.62. Bam. My ratio, risk to reward, is 2.6. That means for every one, I'm expecting to win 2.6. So I'm expecting to win 2 holes and a little more than a half of what I risked. Whatever I risk, I could risk $100, I could risk $1,000, but I'm expecting to win. If I'm risking 100, I'm expecting to win 260. I'm risking 1,000, I'm expecting to win 2,600, 2.6. How we set our take profits to find that risk to reward. When we buy this, we want to look for areas of support and resistance to look for levels of take profit. The most noticeable area of support that was right here. So if I take this line, do a clone right here, and I want to change that to a dash. So bam, that was our level of support that I was seeing that turned into resistance that I see. That would be my first level to take profit. So I want to raise this up to here. And I'm only doing this buy because I'm seeing market return. I'm not picking this buy out because it went up and this is a good buy. No, I'm waiting for market to come back to a level that it left from way over here in March. This didn't happen until April, the end of April. So you had to wait from the 8th, 9th, 10th of March all the way to April 23rd to catch this buy. But now your risk to reward is 4-1. So for this one I'm risking, I'm looking to get 4. That is a sweet buttery trade every week, every day, every hour. I don't care how you look at it. That's how you want to look at risk to reward. Because if you try to buy up here, say if you try to buy up here, your ultimate is you probably going to expect market could potentially come back down here. Why? Because this is strong support. So market could test this area again. I want to be below this. I don't want to put my stops this tight, because then the market could be. And I'm look. This is the 4 hour, but this is typically how the scenario would be on a smaller time frame, like a 1 hour. But I could expect market to come beneath this swing point right here. So I want to be at the lowest swing point. But look at my risk to reward. My risk to reward is 1-to-1. So basically, if I'm risking $100, I'm only expecting to win $100. I don't want to do that. We want to risk a little bit to make a lot. That way you can always lose a little bit, a little bit, a little bit. And when you win, you're going to win a lot. And it's going to overcome your losses and put you in profit. That's how you look at trading, because you're going to lose. That's a big fact. You're going to lose. It's just how much losing are you going to take? Next question. So that's how you manage risk and set stop losses and all that. What are the common mistakes to avoid in Forex trading? Jay, you answer that. What are the common mistakes to avoid? The common mistakes to avoid in Forex trading.
Okay, the most common mistakes.
Discipline in the world. So how do you do that?
No, don't put that tag on me yet.
Yeah.
Common mistake. 1, over trading.
What is that?
Which mean, yes. Which means if you take a lot of trades within a day or a time frame, whatever the time frame may be. So like, let me say it like this. So if you are trading and you like to look at the 1 hour, you shouldn't take more than you shouldn't take no more than, I would say, 5. And that's still a lot for me, because I don't do that. I take like week? 2. Yeah, I'm about to say, like I'll probably take 5 max in a week, and that means it's been a good week.
Right.
You know what I'm saying? But no, I'm saying in a day. If you're looking at the hourly charts, if you're taking 5 or more trades in that day, then you over trading.
Looking at the hourly.
Looking at the hourly. I would say that's considered over trading, because you looking at the hourly, you should be only trading 1 session. You know, most sessions range from
if you want to trade in 1 session, you probably shouldn't even be placing no more than 1 or 2 trades.
That's a fact. But you know what I'm saying? I'm talking to the commonly traders as far as like making mistakes. Then 9 times out of 10 you're gonna be over trading. So I would just say that's number 1. But yeah, that's what over trading is to me. You know, some people think, taking 5 trades a day that's their thing. So it's just like, the feeling. Over trading is, yes, yeah, to each his own. But over trading is if you won 3 trades in a row and you take another trade. Usually if you win 3 trades in a row, you on a roll, and you don't need to Steph Curry from the half court. Like you good. Like you are doing amazing, good job. You done for the day. If you take 2 losers in a row and you take another trade after that, even if you win and hit the jackpot, you over trade. Those are bad habits. Mm-hmm. So that's my definition, our definition of over trading.
You're trying to
yes. 2, over risking. Over risking is loading the boat on a trade, on 1 entry, 1 trade. Not scaling into a winner or a runner, but on the first entry you are going in full leverage. On it. Full leverage means how many units you can put onto a trade. Let's say if you have 10,000 units available and you put 9,000, that's over risking. You asking for it. But yeah, that's one way. That's one way to put it. Yeah, and in a sense, over risking is the same thing with over trading because you constantly putting more on the risk. You putting more up
Trying
there.
to make back losses. Really, that's when that that greed steps in, and that is really greed of winning, but you being greedy because you're trying to make back losses.
So that's crazy that you said that because that was going right into my third, um, point is would be revenge trading, and that's what Six said. That's when you lose a trade and you lose another trade, and now you are trying to get back those two trades in one. You lose that one, now you're trying to get back three trades in two trades. You lose that one, and
And not
it's
only that,
quicksand.
you coming from a smaller account size every time you're trying to overtrade because you losing money. You losing money. So now you don't have that 100 you started with. Now you at 75, but you still trying to
Exactly.
come back to over 100.
And that's
It's
when
easy to
you
go
start
over
to
100.
over leverage.
Right.
Yes, yes. So
Right.
you start to over leverage, try and really catch that back really quick. So yeah, those are my top three: over leveraging, over risking, and revenge trading. Um, yeah,
I like it. I like those common mistakes. That is common mistakes for beginners because you could get into a situation where you start doing good, like you can follow rules well and you can follow a trading strategy well, and you start seeing success, and you're like, well, shit, let's turn this up. They
yeah,
add a little bit more on the risk, and then you may get that 1 week of where your trading is and it could be off. Your setups could be showing up, but they just not working out. Like they getting the stop loss is getting tested before it go in your favor. Sometimes that happen where you taking the setup. It's the setup you're supposed to take, textbook setup, but they just not working out. Last week they was hitting everyone. I was hitting. And if you got risk to reward in your favor, when you take those losses on those damn they didn't work out, it'll just be minimal losses. And then when things start to crank back up, then you'll be back and like, okay, it's working, and you didn't really lose as much. But
right, right,
when you start feeling too good and things working out, and you want to increase that risk a little bit more, add more leverage, add more trade size, and then it just so happened to be that week that the things start falling apart. Now you losing more money than you was making when you had your risk to reward or your risk parameter set at a proper amount
yeah,
according to your equity size. You know, because a person with $100 account ain't gonna make as much as a person with a $10,000 account. Simple as that.
right.
You
But
shouldn't
they
even
can
plot.
both make the same percentage.
Yeah, a $10 account can make 50% a day. That
Yeah,
just means they made $5.
come on.
But a lot of people don't think like, damn, I made 50%. Like, yeah, but can you do that on a $50,000 account? Can you try to pull 25 grand out of that?
Probably not,
Yeah, and be
because you don't know
drawn
what they feel
down,
like.
be drawn down 8K in the process of it, you know. But yeah, good answer, good answer. Last question, number 10. How long does it take? How long does it take to become a successful Forex trader? Well, like I
You got
always
that.
like to say, before you can even talk about how long it's gonna take me to be successful and all that, if you not ready to commit at least one full calendar year of Forex trade, I mean from January 1st to December 31st, no matter how you look at it, even if you start in July, go from July to July, if you are not prepared to really like take losses, take wins, mess up, get better, make mistakes, stop making mistakes, like all that, for at least a year, like you can't even ask that question. How long is it gonna take? Because off rip, it's gonna take you a year of this understanding the market. And I say overall, just to really just be like, unless if you're a robot and you have no emotions, if you got your emotions intact and you really want to make this work and you want this this side opportunity to make sky's the limit as far as the amount of money you can make per day in amount of hours, just you and the laptop at home, yeah, you're gonna need at least a year. At least a year. And I would say furthermore, 2 to 4 years of actively like full-time ish trading. I don't want to say full-time because you're not deriving you're not pulling an income from it or nothing like that. But every day you at the markets, whether it's like at 8 p.m., 6 a.m., 1 o'clock in the morning, whatever time frame, whatever time session you can watch it at. If you actively at the trades, yeah, because you got to develop your confidence and your emotions and be like, you have to look past the loss and I lost money, so I'm steps away from living my dream of being able to quit my job and trade for a living or whatever. You got to look past all that shit, and that's gonna take, like I said, in my opinion, for me, like at least in the 2 to 4 year range, that's when you could consider. So ultimately, I would say 2 to 4 years. That's how long it's gonna take you. But for sure 1 year. I wouldn't believe nobody that came to me and said, "Yeah, bro, like I learned this new strategy. I just started 3 months ago. I'm in my 4th month and I'm good. I'm killing it. I'm about to quit my job." Like, yeah, but you ain't seen what the new year look like. You ain't seen what the winter or the weather can do to a country to shift the market. And like, like it's all kind of, it ain't just the hedge funds and banks moving around money. It's like real world things that shift currencies, wars, and all that stuff. So yeah, like that's why I say time. I'm looking at it from that aspect, not just you learning and like you going to school. Now, like real world events got to happen. Not it has to happen, but you have to give enough time for things to play out, if you will. Another simple way I like to look at it, a good presidential term will give you the real telltale if you bought this life. That's why I say like max 4 years. Real talk.
Yeah, I was about to say I'll definitely say about 4, but I also have to ask, the person that's asking that question, what is success to you?
True.
Like if you would have to define, success being a trader. You know what I'm saying? Yeah, what's up?
No,
yeah,
that's true.
Once you can determine like what's success for you, once you can determine,
is it a dollar amount? Maybe somebody just looking for extra $5,000 a year just to go on vacation, where you could do that very easily in Forex. That's what you want to do. Right. You want to turn into a full term thing, like, yeah, what's success look like to you? Like you said,
I got a definite peace. Gang was good.
What's up, Phil? What's up? Welcome, brother. We all about to wrap it up. I'm glad.
Yeah, I know. My bad. That's why I thought
you came at the perfect time. Though. I'm appreciating.
I say, yeah, we could build after this, but yeah, run it.
Yeah, I came. I was on the 7 to 8, but the definition of success is having a goal and achievement. So it's not that it's it's not that it's something that's unattainable, unexplainable, right, or that's something that's so big. Is really just something that's so general that it could be anything. Like you said, they go, it's $. Somebody goal might be, I just want to learn how to do this and just have another skill under my belt.
Facts.
Right.
So if that's your goal, then if that's your goal or your objective or your meaning for success, then your approach gonna be different than the next person. But I think nobody goal, at least not the primary one, should be money, because you can't get that without at least following somebody else's system or creating your own. So
that's the end. That's the end. That's the byproduct of success, of you
coming
to the markets every day, watching these charts. When you do it in your allocated time based on your lifestyle, and you put the work in, you know, test it out, get in our group and ask questions and all that type stuff. Like really be in there, because it's once you learn it and get it, it's really what's gonna happen. It's gonna be a whole lot of like confusion. I don't know. I'm not getting it. This shit crazy. They going against me. Everybody like I can't win in the markets. And then it's gonna get to a point to where you go find something, a strategy or a setup that you like, and it's gonna get hella boring, and it's gonna get so easy and simple to where it's gonna be like, damn, bro, I could have been doing this or whatever. Like it's really you just getting out your own way, you know, mentally. But you got to go through the process before you could just be like, okay, I'm ready. I'm mentally strong. I'm disciplined. I know it. You know, like it takes time. You got to go through. Everybody go come to this like, oh, I'm good. I'm ready. I'm focused. I got this. I understand it. But once that money on the line and you start really putting your mind frame about like, okay, I could really turn this into something if I really take it serious, and you start taking it serious, and then you get your ass whooped a few times on them trades, like it's real then. And can you handle it then? You know, when you really like, damn, I really want to make this work because I either want to replace my job, or I wanted some extra income, but I can't expect nothing from it if I keep failing, you know. And the failing could be from you not following your plan, or you not trading on the days you were supposed to trade. You only trade one day out the week and wondering why your numbers is off. Like you got to be active. If the market open, you got to at least see what's happening. I ain't saying take a trade every day, but at least be there to see what's happening. And if it ain't setting up, don't do nothing. If it is, go with your move.
Yeah, in order to be successful in anything, you have to work at that craft every day. I don't know what the time limit, but you have to work. You have to put some time towards that, you know, that craft, you know, in order to be successful every day.
Right.
Especially something like this.
Something like this, like these candlesticks. Like we just broke it down in a nutshell. But I mean, yeah, that's basically why we did this. Because like I said, it was a few people that was really, you know, hitting me, and I'm pretty sure it's the same thing to y'all. Like, you know, just asking them same old questions, which is nothing wrong with it. But now, you know, we created a whole video that you could just watch back, go to YouTube, double back, watch it. And if you can't find it, I'm recording it on my on stream, on a Streamlab, so it's saved for life. So we got this, however we got to do it, but it's needed. You know, a lot of people don't really talk about this subject because it's boring. That's why you got baby pips. But I like, what the hell? Let's break down the most common questions or misconceptions, if there's any, that we could talk about, and that's why we did this. So now that we talked about this, I want to send my link so y'all could join our $50,000 a month trading. Hold on, don't laugh. I'm dead ass serious, boy.
Oh, my bad.
No, I'm playing.
At the end of the webinar.
Oh yeah, at the end of the month, I gotta hit them with the.
Now that you made it this far.
Now that you made it this far, and at $50,000 a month, you gonna get live signals. I'm gonna trade for you. I'm gonna wake you up, and I'm gonna let you know when the market opens. So you ain't gotta do nothing. Turnkey.
Facts. No, but honestly, man, like if you did happen to make it this far, that just shows you a lot to, you know, to yourself. It's so hard to just devote
even
time.
The people that's playing it back right now. If you watch it on the preview, like if you made it this far, like dead ass.
Yeah, you sitting into something for like 2 to 3 hours that you have nothing, you know, you don't know about, but you are interested in it. That's what I'm saying. You got to have some. Yeah, man. Everybody. Just like Six said, it's needed. It's needed.
Nothing else. People need to know how interest works. Interest, compound interest. Like that's just basic financial literacy. Probably the most important concept. You know.
How do you look at compound interest with Forex?
Well, just profit. It's profit. Like your money is growing. Even if you was growing 1% a month, you making way more what the bank would give you. And I think that's more what this is for. A lot of people be like, promoting this is like not a get rich quick scheme, but something that's
Yeah, they do.
something fast. It's
Yeah,
not
Yeah.
fast, bro. Like you say, this stuff is boring. As
Wealth,
like
yeah,
at the end
wealth
of the
isn't
day.
fast. Yeah,
Right.
wealth is
Wealth
not
isn't
fast.
fast.
Yeah.
the only thing that's fast is the pivots that move on these price charts. The
The
growth,
volatility.
yeah, the growth and the decrease and the decline, increase and the decrease of your account equity is, and the length of you to withstand that before you can turn it into more of a compoundable increase. That's going to determine, your true
It
worth.
take years. Like a person who invests into a retirement account, right? They looking at from
You're right. It do take years. That's why I broke it down, with at least one full calendar year. That's 1 year right there. And then looking at the presidential term, that's 4 years. So that ties into what he's saying.
not even that's not even a pinch. Like most people in retirement plan, like I said, is 40, 30 years. When you
Oh yeah, for
get with
retirement.
if you get with a financial planner, they're gonna look at your money for retirement, which is the age 65. So, and these people who got 401ks and things like that, they are investing their money into the market too, just not individually, and they just getting less return. However, their money is growing from like anywhere from I guess 5 to 8% a year. Let's just say 6% median number on a 401k, but they can't take it out for 30 years. However, when you look at 6% compounded over 30 years, that's amazing money. When you talk like literally $15 a day will guarantee you a million plus in 30 years. $15 a day at 6% interest. Guarantee you that's about $400 a month. So that's 30 years though.
Right.
And
Talk about the power of like what Forex could do in the short term.
okay. So then you go to the rule of 72.
All
If you
right.
Google the rule of 72 tells you first you get your interest rate. Let's say your bank was giving you 1% on your savings account. So you divide the one into 72. So 72 divided by one is 72, right?
Right.
I mean, one going to 72 72 times. So that means it's going to take you 72 years for your money to double if you have a 1% interest rate. Now, let's say,
And that's an interest rate per year or per month. That's per year, right? I think I lost you, Bill.
You probably go tap back in. I mean, you want to get on the
I cut off.
No,
Yeah.
yeah. You tapped in.
Oh, okay, my bad. I had went to the calculator. So, like I said, that's 1%. That's per year. But if you put in 12%, which is 1% per month, then that would just take you 6 years. 72 divided by 12 is 6. So it'll take you 6 years to double your money with 12% compared to 72 years at 1%. So
And that 1% was a month or a year?
that was a year, 1% a year. What your bank is giving you. Basically, the interest rate that your bank is giving you to flip your money and loan your money out, that's going to take you 72 years to double at the rate that they give. And that's with a 1%. Most people not getting that. I know Navy Federal. I'm not getting that at Navy Federal on my regular savings. You got to put in the money market. They'll give you 2, 3, up to 4, maybe even 5. If you put in like $250,000, I think they give you 5% in a money market account.
So you saying that 12% is gonna take you 6 years?
Right. All you do, you say, what's my interest?
And that's 12% a year. Now we know, and Jay, I know you could agree to this.
Yes, that's 12% a year.
You could
So
make in Forex. So comparing this to Forex, because this is what we're talking about right now.
no. That's actually what I'm talking about that people need to stop doing for real. Because, but I mean, like I know, like
No,
the
I'm just
point
saying that the point of the potential of how you, when you controlling your money and you learning risk to reward, you can actually attain easily 12% a month in Forex. Once you
I
have a
wouldn't
good strategy,
necessarily say easily, but it definitely can be done.
yeah, it can be done. It
I
can
wouldn't
be
say
done.
easily. That's what I'm saying. Like it's not about it being easy. It's about the fact that it could be done,
Right.
and it
But
can't
it
be done
takes
at your
like
bank.
I said, it takes time. It takes time with a
Oh,
proper
Yeah, that's why a lot
strategy.
of people don't trade. You know, like yeah, it can be done, but just like Pip said, it ain't easy. That's why a lot of people don't do it. If it was easy, everybody would
But
be trading.
and I guess I'm speaking
And
from
what you
just
need to
how I
do
look
is
at
get
it.
with a coach. And that's what everything. Like somebody was asking me advice about marketing. I was like, yeah, the first thing you got to do is know your niche. And then I was like, then I'm like, wait, hold on. The first thing you need to do is just go get with an expert who already did it, or somebody
Right.
who's an expert
That's
at what
why
you.
we doing this video, and that's the prime
Yeah,
reason why we doing this video. That's the
right.
prime
Because
reason.
y'all might not know everything. And that's what I said. I might not know everything, but I know more than you
Right,
regarding this subject. So I can help you out a little bit. I'm
right.
not saying that to toot my horn. I'm saying that look, I know more than you on this.
No,
Come
that's true.
ride my wave.
When you want
You
to
know what
help
I'm saying?
somebody, you extend that offer. That's why we doing. Like we ain't charge nobody for this. We
Yeah, so you
sharing
already
our
know it's
knowledge.
all love. If y'all ain't
Yeah,
charging, it
yeah.
can't be nothing else.
Right.
It ain't got no million streams on it, and y'all consistently doing it.
Come on,
But
man.
I just want to say that, like I think if people stop saying, oh, it's easy, you could get rich. Just say, look, this is what you're gonna make with the bank putting up $400 a month. If you follow this simple, basic risk management strategy with trading, you can easily make. Well, see, y'all got me saying if
Yeah, but you can though. But
you,
it's real.
it is easy though for us though. It's easy
I
for
know,
us.
but it's
It's easy
good for
for us.
people to hear that because with time they could be talking like this too.
Yeah, I mean anything is levels. Is levels like
Facts,
it's
facts,
levels. Like
facts.
so, but it definitely could be done. Well, let me say this: that fucking one that 1% a year that you get with the bank. Yeah, you could easily make way more than that trading. Fuck that. You could easily make more than that fucking 1%. You know, but saying easily 12 and 10, like some of the best traders is making hella money off 10 to 12%. Professional managers, money account managers.
Yeah,
So
that's typically what they touch. They touching like
yeah,
maybe 20s to 30s on the good ones, but yeah, a good one, a decent one, yeah, you're gonna get you about like 12,
that's
15%
yeah.
on your money a year. But these people putting up 50 million.
Well, no, what I'm saying is like that's the type of numbers that they do
Right,
per year. That
right.
and that's all these institutions is really requiring them to do.
And that's just the average because January they could be up 40%. This February they could be down 20%. Then it's an average. On average, that's what they average out for your money every year, be like 15-20%. But yeah, there are all those times where you have great returns with whoever you're investing with.
Right. Like a
But
mutual fund that gives you 8 to 12%. And just to use that for example, that's a way that you could get compound interest, a higher interest rate, which means it takes shorter for your money to double. You could just go with a mutual fund and let a professional do it for you directly for you though. A person who you could talk to, this and that. Yes, there's risk involved, but it's way less risky than doing it yourself because these people are like trained experts, professionals, tapped in with the bank, got hundreds of millions of dollars on the line, so they have to. You see what I'm saying? They
right,
got
right.
the best of the best people trading your money. And you could get 8 to 12% like that doing nothing. So, trading is cool, but some people it ain't for everybody.
No, it's
However,
not. It's definitely not.
You
But with
still
the
should
with the proper,
investing should be for everybody. Everybody
yes,
wants their money to make money.
yes. That's why
You s-
back to what you said, you need a support system with any type of with anything you ain't ever did before, first of all.
You're right.
Get some kind of support system, and typically somebody that did it before in the form of a mentor. So, you
Yep.
know, with this trading, you know, with this Forex markets and our confidence, yeah, you can definitely learn this skill and put it to your good use. Like I said, you ain't definitely got to replace your job. This could be something you could just trade and make some money to go on a trip every year.
You make money while you at work.
You know,
I
so
was just talking to one of my options. He trade options. He's the #1 videographer in the state of Florida. He stopped doing that just to trade options, bro. He having success. We can run about that off camera. He sent me, yeah, man. I don't know. I'm gonna try a little something. Just try, cause bro, people get money over there. But like like I said, he's the #1 videographer. Dude paid, and he gave that up just to trade. So that just showed the people the power of trading. His coach got $1 million in his trading account. He risked $100,000 per trade.
man,
Some people
how
just
much is that
chilling,
a pip?
huh?
How much is that a pip?
I have no fucking idea.
I would probably say in the range of anywhere between $1,000 to $10,000 a pip.
Yeah, probably so. Yeah, no less than that for sure.
Yeah. But well, we're gonna wrap this up. As you can see, he on this little explainer trade is still in heavy profit. He moving his parameters around. I don't know what he done did. I think he still did you change your take profit on this?
Yeah, right now I'm in the zone. That dotted line, if it closes above that, going into 9 o'clock, I'll move my stop loss up to that area, and then if you look further up, right here, that's where my ultimate take profit is, which is 67.39.
Bet.
Yeah.
So yeah, man. We'll probably be talking about this trade tomorrow morning. You know, on the live. We'll see how high that one actually went. I think that's up there near that 4-hour gap, that old 4-hour gap I had marked out earlier.
Mm-hmm.
Yeah, so that's good. Good little volume on Tuesday.
Right quick, man. On the
Right.
on the live
Right.
on the live webinar, man. It's amazing.
But yeah, man, like I said, y'all tap in. We on YouTube, yo. We got the Telegram. Y'all tap in if y'all need any type of help, any questions or whatever. We here. We gonna keep running it up. Like I said, this forex market is great to us, so we trying to just extend the knowledge. You heard me? But with that being said, we out, man.
Appreciate everybody. Peace. Y'all be good. Whole bunch of love, man, and prosperity for real.
Peace, discipline, success.
That's it.
Yes, sir. All right, man. We out.
Peace.